Are you ready to rumble? It is Friday, October 30th, 2020, day before Halloween. And I am going to reveal my very, very famous, since 1988, never before wrong prediction on the presidential election. A lot of you already have a clue what that's going to be. Last night I wrote an article, a second wave correction could send stocks down 30%. This article has only been on the Seeking Alpha website for under an hour. And already I'm getting all kinds of comments about how I've been wrong, about how this is wrong and that is wrong. And the Fed money printer go burr, and the Fed's just going to pump everything back up. We'll talk about that. There is a pretty safe bet that we're going to be choppy for quite a while here. Do we get a 30% correction? I'm not saying that that's an automatic. I'm just saying that if you're not considering that that could happen, and if you're not preparing for it and you're not protecting yourself from it, then you're probably not doing what you should do from a risk management standpoint. So what is the general thesis here? Well, the general thesis is that, I've been saying since, I'd say late May, that folks ought to manage their risk very tightly, because the state of the economy is such that we are actually in a depression. And among some of the things that have been said to prop this market up, there's so much that's wrong that it's kind of unbelievable. Now, this meme here, the whole money printer going burr thing, it has a lot of truth to it. We've taken a look at the Fed charts of them printing money, and since the June correction, they have progressively added just a little bit more money to the market almost every week, for sure over 2 and 3 week periods. But anytime the market was challenged, such as in September, they actually ramped up their additions to their balance sheet even a little bit more. So, what we need to be aware of is this. The economy is horrible, and the stock market is almost 100% correlated to Fed liquidity right now. So any pullback in Fed liquidity at all, right, even just a pause in expanding their balance sheet, is going to be bad for the stock market, because we know, as we talked about last week and the week before, there are net outflows from stocks among big investors and older investors, and the money coming in from hedge funds and small investors is not enough to cover that. The only reason that the stock market is going up is because the people who are in are using leverage and call options. The minute it becomes difficult for them to do that, and we've talked about how brokerages are sending out notices about constraining margin, the minute it becomes hard for hedge funds and then small investors, but the hedge funds probably the first linchpin, to be leveraged to the long side, they won't be. And we know that the hedge funds basically can pull the carpet out from under the millennial investors. We need to be very careful of not getting caught up in that storm, because the market could fall straight down just like it did in March. Now, will it happen? I don't know. Could it happen? Yes. Is it probable? I'm inching towards saying it's probable, but then at some point the Fed steps in. And when does the Fed step in? I think Tuesday is a lot more binary than people give it credit for. Jerome Powell's been helping President Trump since June and before that. And he's engineered largely this money into the bond market and to the banks and to the primary dealers that has, again, found its way into the stock market. If he backs off on that because he's a partisan, and I don't really know if he is or he isn't, maybe he's just keeping the stock market up because he thinks it's the right thing to do. But as I cover in this article, there's a choice coming, and that choice is going to be between the dollar, bonds, and stocks. And you can't save all three, probably, not without having just horrific consequences not too far into the future in the form of stagflation. So at some point, it is the dollar that wins and the bond market that wins and the stock market that loses. And I cover that in the article. At the start of the year, I forecast that there'd be an early year volatility event, followed by a rally in the S&P 500 to about 350, 360 on SPY, so 3,500 to 3,600. And that's basically where it got. And then I said before year end, there'd be a correction to between 220 and 240. That was just based on a confluence of fundamental and technical factors that I've been tracking for years. In fact, I first said this to Mark Yusko way back in July, I think it was, of 2017. You will have seen the chat that I've had with him. So this is a conversation we had. When was this? This is a long time ago, July 2017, right? His supposition way back then is that the market was delusional. And I was like, nah, I think it's just that enthusiastic. So I was saying in 2017, it still had a good rally. So I said, bet you a dime that at some point in the near future, there'd be a 9 to 19% correction because nobody wants a bear market. So the Fed's got to step in. Well, in February of 2018, that's exactly what happened, right? It's exactly what happened. And then I said by 2019, the SPY would be at 300, which is about where it got at the end of the year. So I've been tracking this a long time. I thought that we were here in 2017, and then at the end of 2019, I thought we were up here. And we've had this correction so far. People think a return to normal, and this would not be uncommon. It's not guaranteed, but it wouldn't be uncommon. So we'll see what happens. I covered in this article some charts. GDP is not only below where it was, right, in Q4 of 2019, but it's below the trend line by quite a bit. So when you see those tweets about how, the mainstream media is not covering the economy getting better, the reality is that we haven't come close to recovering what we lost. So we have to be very careful about thinking that we've had this huge rally. So this is another Fed chart, right? As I described, starting in 2018, the economy started to turn over, right? This is change in GDP. Everybody said, no, it's still great. Yeah, but it's rolling over. And it's the rate of change that impacts the market. You're seeing that now with the technology stocks getting beat up because even though they beat, their outlooks weren't as rosy. Their outlooks indicated some rolling over, not from good to bad, but from good to less good. And from good to less good is often a harbinger of bad in the future. I don't think tech has that problem. I think that tech is something that you buy on corrections like every single time. But this correction could get a little hairy, especially with the lawsuits that are out there on antitrust. And I do think that there's going to be some forced breakups and conditions placed on Google and Facebook for sure, and maybe Amazon, but I'm not so confident that Amazon gets sanctioned in any way, but I think Google and Facebook probably do. And that's why we've been buying Google over time because the baby Googles are coming. Facebook will probably have to spin off Instagram. So we'll see how that impacts that company. I'll tell you what, if Mark Zuckerberg is no longer running Instagram, I'd probably buy that stock after they spin it off, especially if I can get it without some big IPO style bump. In any case, from here to here, the Fed printed $1 trillion to bail out the repo market. And we've talked about that a number of times. Repo market needed to be bailed out because there were a couple big players that were in big trouble, long-term capital style trouble, the type of collapse of an institution that's happened in the past. And they rescued them, and that helped GDP a little bit. And then we got that stock market rally into January. Starting in February, the market started to turn over. There was a little bit of coronavirus news, but really the economy was starting to turn over just like this again. And then we had the coronavirus crash. And what I want you to notice is that this is about a 32% drop, I think 31.8 or something, right? And then we recovered, we had a 33% recovery. I want to walk through some very simple math. If you have 100 of something and it loses 32%, you're down to 68. And let's say 69, just because it's an easier number to use. So you go from 100 to 69 with a 31% loss. A 33% gain does not take you back up to 100. It's 33% of the 69. So a third of 69 is, right, 23. It gets you up to 92. So you're still 8% underwater. And that's almost exactly where the US economy is. So we need to be aware that we're not back to where we need to be, right? We're not up here yet. Still trillions of dollars short. And it's probably going to take 2 or 3 years to get back to trend. And that is presuming that we have an effective vaccine, which I think we will. But I think we'd be smart to consider that's not guaranteed. So we looked at this chart last week. Unemployment, still 23 million people collecting claims. And I talked about small business here. So this is from Bureau of Labor Statistics. These are all small businesses of varying sizes. Your 1 to 9 person small business, you've seen about 4% of them go out, right? From the standpoint of employment. And then as these companies get bigger, you're seeing them lay off more people, but you see the uptick in the bigger ones. It means that the ones that stayed in business are starting to hire again. And you have your flattening of this curve, meaning that your super small businesses, they're either going to disappear or they'll hang on. But like me, I was considering adding an employee last summer and I didn't do it. I'll probably do that next year, but I needed to hold off because I needed to make sure that my cash flows were what I thought they'd be. Turns out that they are. And I've been interviewing people for 2 different roles, actually. I might add 2 people, and I might open an office in downtown Milwaukee just because it's a cool neighborhood. And there will be entrepreneurs that do that, will take advantage of the lower rents, the lower real estate prices, the ability to get labor in a slack market without having to, get job owned for higher wages. I'm going to give somebody what I think is right, and I always give a really good bonus schedule because I want motivated people. Ultimately, coming out of these corrections, entrepreneurs tend to do well. The problem that we have and have had for a very long time is that one of the biggest impediments to entrepreneurship is healthcare. And we need to make sure that we have a healthcare plan. So we've taken a look at the valuations from here to here, just only be 2 standard deviations overvalued, pulls the market down to 2,700. This will pull it down close to the bottoms, probably beyond the bottom. So if we got anywhere close to normal, right? I'm not even saying get back to mean, just the 1 standard deviation outside of normal. Just to get to this line, we're going to set new lows. Think that through, right? This is where it got in the spring, and we only got down to 2,100 on SPY. What if it got all the way down to here, right? That means that the megaphone gets all the way down here. Again, I'm not saying that's going to happen, right? And then you have your Armageddon scenario, breaks through the megaphone, in which case you ask people that may be leaving you money at some point for the inheritance early so you can buy stocks. Because down here you buy stocks and you don't even have to be too discretionary about it. Just and you probably even get a little bit leveraged. So, I think that the price that we're going to see on the S&P somewhere in the orange box, that doesn't mean it can't stop going down here or keep going down to here or have the Armageddon scenario. But I think that this correction is in full force. Does it stop here? Depends. Does it get fire hosed with Fed money? Well, let's talk about that. Okay. So in any case, so the Armageddon scenario was this: a wicked second wave of coronavirus, the drying up of Federal Reserve and U.S. government relief efforts, and then trade conflicts. And for a short period of time, for a few months, we could see this play out. And with as fast as the stock market's been moving, you could get that one spike down, and then it'll jitterbug its way back up. So if we get that spike down for a week or 2 weeks, we have to be ready to get fully invested. Where is my Fed? There we go. So you've heard of no alternative. Tina. I was talking to one of the commenters on this article. Just a quick little blurb. He goes by Salma Trutto, I believe it is. and he's some sort of professor out in California, I think, or grad student or something. And I'm pretty well versed in economics, and even I have a hard time reading this stuff. And I've read the general theory, and I've read Schumpeter, and I've read all these guys. Uh, this commenter here is pretty complex sometimes. I think he's over people's head. It's like a Dennis Miller joke. You're pretty sure it's funny, but you're not positive. Well, you're pretty sure that what he's telling you is smart, but you're not positive. In any case, the battle that we've talked about with the Fed is at some point they have to decide what's most important to them. I think we talked about this 2 or 3 weeks ago. You have the dollar, you have bonds, and you have stocks. And the Fed doesn't like to see everything going down at once. The problem is if they fire hose money, that means the dollar keeps going down. And what do we know about the dollar crashing? It usually leads to a financial crisis. So the Federal Reserve is going to probably have to engage in some sort of yield curve control that's not going to be good for stocks, but they should be able to preserve the low interest rates as well as the dollar by handling the curve. But you're probably going to see that be negative for stocks. So if they buy certain points in the yield curve and sell other points, basically net neutral on the balance sheet, but changing the direction of interest rates, keeping the longer end maybe a little lower, sacrificing the front end. And now you have a flat yield curve. That's not good for stocks, right? We've heard about the inverted yield curve, and I find that hard to believe that would happen soon. But you can see the yield curve flatten with 10-year interest rates staying just a little higher than they are now, but then the low end also rising. And then they'd have to rely on fiscal stimulus. Well, a couple of weeks ago, maybe a month ago, Jerome Powell went on 60 Minutes and basically begged for more fiscal stimulus because he's getting to the point where he's got to face a decision: do I protect the dollar? And they're going to have to protect the dollar. Otherwise, just like I showed you in other charts, when the dollar collapsed under George W. Bush, right, the hot money got moving, and then you had a financial crisis. It would happen the same way again. So I did end the article because I get tired of being called a perma bear, which is not true. I'm extremely bullish on the long term of America. I'm even pretty bullish on the intermediate term, but I think that there's some big problems, and I think that we have a retirement plan crisis that we're going to have to deal with. Right now, the Republicans don't want to give any money to bail out pensions, which is a horrifically bad idea. We need that money in the economy. And the weird thing is that if we bailed out the pensions the right way, right, through the Pension Guarantee Corporation, then we could have that money trickle into the economy over 30 years. It would offset the deflationary pressure of the boomers aging, and it really wouldn't be a hyperinflationary event because the money's not coming in all at once. This is the helicopter money scenario that I think makes sense. And I'm going to write a letter on Medium, open letter to Joe Biden, and just say, look, man, it's time to print an economy, but then trickle it in over a very long period of time. And that would be your bailing out of the entire retirement system. If we do that, we get a few points in inflation short term, but really all it does is offset the deflationary pressures that are in the economy. The long war of deflation versus inflation, which is going to go on for another decade, probably 2 decades, is not anywhere close to being over. And the deflationary pressure of demographics is massive and completely underappreciated by 4 out of 5 investors and economists and politicians. So weirdly, everybody calls her Crazy Nancy, right? I don't. I think Nancy Pelosi is brilliant. She's absolutely right to want to bail out the pension system because that is an offset to deflationary pressures, and it keeps a huge portion of the population from becoming broke in older age. So here's our investment barbell, pretty simple. We want to be in tech and communications, industry that uses tech well, right? One of our stocks is doing all right despite the carnage in the market. Consumer discretionary, which is pulling back right now. So probably get an opportunity there, Apple, alternative energy, and biotech. Then we have the REITs, right? I've been going through these REITs, and I'll tell you what, the REITs that are popular, they're going to all have to cut their dividends, some of those office REITs. And I think Simon's in trouble because I was reading the bankruptcy filing on JCPenney. You know, I just don't like what Simon did with JCPenney. If that deal ends up going through, I think it's bad news for them. They ought to just call Amazon and say, hey, how would you like to have, you know, Whole Foods in all of our malls? Gold and cryptocurrency. We're getting the pullback on gold that I told you would happen a month ago into the election. Bitcoin is getting bought by institutions now. And I think that Bitcoin is going to end up being somehow quasi-pegged to the dollar, not because the Bitcoin developers will do it, but because the US government will figure out a way. That doesn't mean that cryptocurrencies aren't going to do well in their particular niches. And you have to really understand what each one is for. But Bitcoin, there's a possibility that it goes from casino chip to currency, right? Maybe that's even the title of an article I'm writing. And it could get that hockey stick up before it slowly drips down and finds some sort of equilibrium. It has to find a narrow range of value, or it won't succeed as a unit of exchange. And that's what you need for a currency, is a lot of people using it. Materials, in this article, I mentioned fertilizer, so we'll finish up with that. Then again, alt energy, right, your yield codes. And then there's certain alternatives. There are private equity companies out there that I'm very interested in. One of them just invested in the company that I told you I was trying to find a backdoor investment into, a company that can turn methane and carbon into plastic. Sucks it right out of the air and turns it into plastic. So the refinery businesses are in big trouble, and petrochemicals are in big trouble. So where can we find value right now, though? Again, we need to define what value is. Value is not the whole, I'm trying to find something below book value using a Benjamin Graham formula. It doesn't work then anymore. The algorithms and the computers find those discrepancies instantly. And then if there's any true value there, big investors get in there. What you have to become good at is two things. You need to be able to find value by finding growth before others do, right? Expected growth. So you need to be able to project out 1 or 2 years and find the growth that's coming before the whole market does. And then you need to find tomorrow's scarcity before it exists. So what's going to be scarce in a year or two? We've talked about copper. We've talked about fertilizer. There are a number of things that we're going to use for agriculture and for alternative energy, and generally just doing infrastructure projects, that if we can buy the dips here, we probably should. You know, the company that's on our very short list, on our plug and play stock portfolio for this quarter, it's probably going to get close to the buy price and get into our buy zone. As far as the fertilizer companies go, so for the public, I put a list, right? I gave several companies that are companies that I'm interested in. So German company KNS, and then ICL, Israel Chemicals. Those will both be added to our international watch list. Probably get it done today. Scott's Miracle Grow is very interesting in the cannabis industry, right? You know that we already own Nutrien. I don't think we need to own Mosaic because we own Nutrien, but we could. They're part of the same oligopoly. And then CF Industries, which has gotten beat up a little bit because of supply chain issues and then supply and demand imbalances, could be a buy as well. They've traditionally performed the best. So, you know, CF is one to look at. Israel Chemicals is very interesting to me. If I could build a basket of all of these companies, I probably would. If there's an ETF, I haven't found it yet, but all of these companies here, all 6 of these, are worthwhile for you to look at. So far, I'm only in Nutrien. I need to figure out where I should buy Israel Chemicals. I have to find out if the problems with KNS are short term or if it's going to be permanent, and then if CF is going to get around the bend. So I saved this for the end because I know that not everybody's interested. We're going to talk about the presidential election because every year I make a prediction every 4 years. Here it is. The next president of the United States will be Joe Biden. I don't have any doubt about that. So my official Electoral College vote prediction is that Joe Biden will get 368 to Trump's 170. I just couldn't find my way to believe Iowa will flip blue, or that Texas will flip blue this time. I do think Florida is going to go blue. I think Georgia is going to go blue. I think North Carolina is going to go blue. Back in early 2019, I started talking about Joe Biden or another Democrat winning by 10 million votes. I'll stick by that. We know that there's going to be over 140 million votes this time. And even with all of the extra voting, it's going to be a challenge for Donald Trump to replace the Never Trumpers and the Lincoln Project people and the people who follow John Kasich. It's just going, and Mitt Romney even, it's going to be very difficult for the president to replace the votes that he loses. But let's say that he does. Let's say he finds some millennial voters and people who hadn't voted the last time, but they like him. Maybe he gets 63 million votes again. That's what I'm projecting. I'm projecting that Trump gets 63 million votes, that Joe Biden gets 77 million, and there's a couple million that go to libertarian, green, things like that. So I'm looking at low 140s on turnout because I think that at the last minute, you may not see the surge on election day that some people are expecting. I think that people are going to see these lines and they're going to say, I don't want to stand there. So it'll become a matter of conviction. I think some of the Trump voters might just say, we're getting crushed. And I think that some of the Democrat voters might say, it's a landslide. And I do believe it'll be an essential landslide. This is the top end for Biden. If he can flip Iowa and Texas, he can go over 400 electoral votes. If this happens, as an investor, you need to start saying to yourself, wow, that's a mandate, right? And if that's what happens, Joe Biden's going to have a very hard time getting pulled to the not getting pulled further to the left, which I don't necessarily think is a bad thing, particularly for climate change policy and healthcare policy. You know what I think about both of those things. I think that climate change is real. I think we can use primarily market mechanisms to deal with it. I don't think we need a Green New Deal. I think Joe Biden wouldn't bend on that, but we should penalize the polluters to make it more viable for the alternatives. Although we know that at this point, anytime the sun is out, solar is the cheapest form of energy out there. So we use 70% of our energy during the daytime. What does that tell you? In healthcare, the public option will probably just lead to Medicare for all at some point, because with the public option, the corporations will petition to be part of that, and they will use it and then just buy a Medicare supplement. So my view is that we should just put the whole country on Medicare for 80% of our healthcare. You can opt out if you want to. You're still going to pay the tax. And if you want to have private healthcare, fine. But really, if everybody had Medicare as a base with preventive coverage and 80% coverage, and the government negotiating pharmacy prices so that we didn't pay 6 times more than the rest of the world, and then you and you and you and you and me, we all go find a supplement through the private market that makes sense. United Healthcare sells a ton of Medicare supplements, Blue Cross does, things like that. So if this happens, then what I just talked about becomes more likely. Here's the scenario that we should be very afraid of. I don't think this is likely, but it's not impossible. Let's suppose that President Trump holds on to Florida by a couple of votes, Texas by a couple of votes, Georgia and North Carolina by a couple of votes, and Ohio by a couple of votes, right? He's anywhere from 1 to 5 points down in all those states. And I believe, unlike 2016, where the margin error went towards President Trump, I think the margin of error will go away from President Trump this time. I think that the minority vote that's coming out, the black vote in particular, is going to be so overwhelming that rather than being skewed The polls being skewed towards Hillary Clinton as they were in 2016. Then Trump took the margin of error and won. I think Joe Biden is going to capture the margin of error and win by even more. But maybe not. Maybe I'm wrong, and these states stay red, in which case you have a pretty close election. In this scenario, President Trump has already laid the groundwork for Supreme Court challenges in Wisconsin, Michigan, Pennsylvania, and I think Minnesota too. And he'll try to throw this to the Supreme Court that he just added another supporter to. Now, in reality, the new Supreme Court justice should recuse herself based on history. I don't think that she will. So this is still a scenario that is bad for the market, right? This means that the Senate doesn't flip. But both of these scenarios, what I'm talking about being most likely, and then this just being possible, it would be amazing to see Texas go blue, right? Those scenarios probably is the most bullish for the market, according to Wall Street, according to me, according to most people who watch this. The most negative thing for the market is if President Trump survives, it ends up being like a 50-50 split in the Senate, and the House is still controlled by the Democrats. In that scenario, I just think that we're set up for some bad things. So we'll see what comes of it, right? Because uncertainty is usually bad for the market. The reason the market likes this, because it adds certainty. The reason the market doesn't like this, so it doesn't know what's going to happen. So here is a little fun that we can have. I put together a little slideshow of the next president. I call this one, Joe Biden's running because he's up to his eyeballs with Trump. Let me level with you. Can we handle being leveled with? Can we handle the truth? Do we need him on that wall? Squirrel. And let me tell you something else. When I saw that kid getting beat up, I called the police. And another thing. Wait, another thing. Wait, another thing. Channeling Howard Dean. Yeah! I can't believe it either. I'm the president finally. All right. Does anybody want to ask a few questions? And we could probably get to some charts. All right. Somebody asked me, how am I managing my oil shorts? So again, if you're not reading my articles just for the comments, you really should be, because they're pretty awesome. So I am short Exxon, Occidental, Continental Resources, and then XOP. And I think that in the next few days, I'll probably take my profits there. So let's just take XOP, for example. We'll take a look. This is the weekly chart, right? So 29-ish is about where it's probably headed to. Right now it's 39. That would replicate the low that it had in March. And clearly things haven't gotten any better for the oil companies. So as we keep going down here into the 30s, at some point I have to manage the calendar. Now I have puts for December and January. Those December puts I'm very likely to sell next week, okay, and take my profits. And then we'll see about the January ones. ExxonMobil, I've shorted this 3 times in recent years, every time done pretty well. So ExxonMobil is heading down to, again, 28-ish is about where I expect them to get to for now. Ultimately, I think Mobil is a $10 or $12 stock. I just think they're in big trouble. But this is, we need new charting in here. So I'm not sure exactly where it gets to down here. There is a possibility they really get beat up. They're cutting 15% of their labor force and trying to reduce capex by $30 billion over the next couple of years. You know what they could do to capture that money? Cut the dividend in half. For whatever reason, the CEO and the board want to maintain that dividend. It's a matter of pride, but it's not a matter of pragmatism. So I am concerned that I need to probably hold on to a couple of my Exxon puts, or if it gets to here, 30-ish, 28-ish, take my profits, probably next week, Monday or Tuesday, because I want the uncertainty of the election, right? If all of a sudden we know Tuesday night Biden's won, I don't know which way this goes short term. So probably by Tuesday, I take my profits here on all these, right? On all the December puts for sure. And then the January puts, maybe not. But I would for sure short them again if they popped up here to the upper 30s. But I'm wondering, can they just go straight through this line? The market hates them right now, and they should. It is asinine, the management job that Exxon's management is doing right now. Take a look at what Chevron's doing and what Exxon's doing, where they've been over the last several years. It's just this CEO is just a knucklehead, and I don't know why they keep him. To be honest with you, they're gonna throw him under the bus next year, and at some point, Exxon, because of the debt that they've taken on, they're gonna have to cut the dividend. And then they're going to probably need to spin off their entire midstream. And I think that Chevron and Exxon could do something pretty smart by both spinning off their midstream into a separate company, because there will be a lot of suckers who will buy it and they can wash their hands of it. And then they can shrink and still pay off a ton of debt. So we'll see. Remember earlier I told you there's a private equity firm that invested more money into the plastics company that makes plastics out of methane and carbon dioxide. That's going to crush petrochemicals. And oil midstream, we know, is never going to grow again. And gradually, they're going to have to give better pipeline deals. So, we need to be careful with midstream energy. Occidental, they spent all that time building that company, and then they destroyed it quick. Occidental at about, what would that be, $1? Yeah, there's a pretty good argument for taking your profits on the Occidental puts right now. Just look at it go down. I might take my profits here this afternoon. I'm going to look at this a little bit more closely. Maybe take a look at 4-hour charts. Yeah, you could take your profits on your December Occidental puts right now if you wanted to. You could. I think it probably goes down a few more dimes, maybe by the end of the day. Occidental is not unlikely to go bankrupt or go down to like $1. This is Chesapeake Energy squared, cubed. Just a horrible job of management. Complete unwillingness to accept the future for what it is. And then Continental Resources. Harold Hamm has destroyed his company too. So good for him. And notice that this looks a lot like this. So I think Continental gets down to $6 or $7 imminently. So my January's for sure I want to hold on to. And the December's, I probably get rid of the December's on Tuesday is my guess. So that's what I'm looking at with the oil stock shorts. Okay, so we own some Ford calls, and these were on the suspicion that they were going to have blowout numbers, which they did, and that the CEO would talk about the future of Ford as a hybrid and EV company. He hinted at it 3 times in the conference call. So if you listen to the conference call, I was sitting here listening to it, and my girlfriend was very irritated with me for doing so. You heard him 3 times talk about, in the spring, we're going to go through the entire plan for hybrid and EVs, which means that they're just working out the details. That's what he said. I think that he wants to see how sales do in the fourth and first quarters, right? So that he has cover for whatever he does. And I think that Ford is probably one of the best buys in the stock market right now, because when you project out their sales for EV and hybrid F-150s and hybrid 250s and 350s, when you project out their sales for EVs, the Mustang, and then eventually the Fusion, or if they keep the Fusion, but they're going to have EVs. All the smaller vehicles will be EVs. The Bronco, I think, is going to go hybrid, but maybe it stays gasoline for a while. But I think the Bronco goes hybrid, and that's the closest that you get to an ICE vehicle from them after 2025 in that size category. If you get a spike here, we're only the calls I bought only cost 14 cents, right? I bought the $10 calls. So I tried to sell them for 18 cents at the open yesterday, and I couldn't get it. So I'm just holding on to them right now. In the next 2 or 3 weeks, I have to figure out before the end of December, and really probably within days of the November expirations. So the November expirations are the 20th. So in the next 3 weeks, I have to figure out what I'm going to do with these. Otherwise, the time value dissipates. So what I'm hoping is that after Tuesday, there's a big rally in anything alternative energy related. And maybe Jim Farley says, yeah, we're leaning into that hybrid and EV direction. Jim Farley, the CEO of Ford, is a good CEO from what I can tell, but he's cautious. He's very engineered, got to have a plan. He is not shoot from the hip Elon Musk, right? Elon Musk had to get reined in because legal things. I would like to see Farley just get a couple of drips of Musk blood, right? One of those vials that you put around your neck. Just keep them remembering that by reaching out to the millennials on their concerns, that's good for his company. And that's what he needs to think about. And I'm going to throw that article out there probably Wednesday of next week after the election. And hopefully he reads it, and hopefully somebody gets in his ear and says, look, man, talk more about the EVs and the hybrids. You have to be 100% committal, but talk about them like every single day. When they do that, the stock goes straight up. So even if these calls don't hit, I'm going to keep buying calls on Ford over and over and over again. Because at some point, they hockey stick. All right. I think that's it for today, folks. Have a great weekend, and go Pack Go.